Good afternoon. This is the Asymmetric Daily Brief for Saturday, August the 15th, 2026. Markets are closed today, so everything we quote is Friday's close. The story of the week is this. Jane Street, one of the most competent trading firms that has ever existed, lost roughly $15 billion in July. It was their first negative trading month since 2016. And yet they are still up more than $40 billion in net trading revenue for the year, which is more than they made in all of last year. Everyone read that as a firm in trouble. We think it is the opposite and far more interesting. Two of the biggest artificial intelligence casualties of this month were leverage events, and neither of them appears on any balance sheet you have been reading. That is the brief. Let's walk it. The board, the S&P 500 closed Friday at 7,785.76, down about 0.2% from a record set earlier in the week, but still finishing its third consecutive weekly gain. In rates, the 10-year Treasury finished around 4.68%, which is a calm number, and it is the market saying the Federal Reserve is probably on hold. But the 30-year auction this week cleared at 5.216%. That is the highest yield the United States has paid at that maturity since 2001. Gold settled near $4,437 an ounce, firmer on the day as the dollar eased, and as always we quote the level and the dollar driver, never a contested percentage. Crude fell on the week as the Iran situation de-escalated through sanctions rather than strikes. Consumer sentiment printed 51, down from 55.2, and Bitcoin is near 62,900 with no real bid. The board is arguing with itself, and that argument is the story. First read, the consensus view is that the artificial intelligence bubble question is a valuation question. Is 30 times sales too much? Is 40? That argument has run for 2 years and it has settled nothing because valuation alone tells you almost nothing about when something actually breaks. Here is what the tape said this week instead. Bubbles do not pop because a ratio got too high. They pop because somebody who borrowed money is forced to sell something on a day they did not choose. And this week, we got the first real evidence of where that borrowed money is sitting. Jane Street's $15 billion hole did not come from a bad view on artificial intelligence. It came from exposure to somebody else's leverage on artificial intelligence. High conviction on this one. The right question is not what is it worth. It is who is levered and against what. The specifics. There was a hedge fund called Situational Awareness, run by Leopold Aschenbrenner, a 24-year-old former OpenAI researcher. It was concentrated in the artificial intelligence trade and it was levered. At its peak, it managed about $45 billion within a single month that fell to roughly $10 billion. It was margin called and it fire-sold the bulk of its equity book to Citadel. Jane Street was one of its backers. So a fund can be completely right about the technology and still be destroyed by the financing wrapped around it. That is the distinction almost every write-up this week missed. Second read, Broadcom fell about 6% on Friday, on a research note, and the number that went around was $370 billion of artificial intelligence debt. We need to correct that because it is wrong as circulated, and we are not going to repeat a viral number just because it is dramatic. That figure is not debt Broadcom owes, and it is not on their balance sheet. It is Bank of America's modeled maximum residual value guarantee exposure. In a scenario where a financing platform called XPV scales all the way to 20 gigawatts, the modeled extreme loss is about $42 billion. Bank of America did cut Broadcom's issuer and bond ratings to market weight from overweight, so the concern is real. But the honest version is smaller than the headline, and the structure underneath it is far more interesting than the number. Here is what it actually is. Broadcom makes custom artificial intelligence chips. In June, it set up a vehicle with Apollo and Blackstone and a group of banks. The first tranche was about $35 billion, covering more than a gigawatt of chips, and those chips are leased to Anthropic on a 5-year agreement. So private credit funds the build, the chips are leased rather than sold, and the debt sits inside the vehicle rather than inside Broadcom. To get that financed cheaply, Broadcom provided a residual value guarantee on most of the debt. A residual value guarantee is simply a promise about what something will still be worth later. If you have ever leased a car, you have met one. And that is where the real risk sits, because it is not the size of the number. When you lease a car, Everybody knows what a 3-year-old car is worth because there is a deep second-hand market. There is no mature secondary market for custom artificial intelligence accelerators at all, so that residual value is not observed. It is assumed. Third read, the consensus in crypto this week is that the Clarity Act, the bill that would finally decide who regulates digital assets in America, passes before the end of the year. A former congressman said so confidently on television, and it was shared everywhere. The tell says otherwise. Prediction market odds of passage have fallen below 20%, down from a high near 58%. And the date everyone is circling, September the 15th, is a cloture vote, which is a procedural vote on whether to proceed. It is not final passage. Medium conviction, because legislative timing is genuinely hard to call. But there is a second thing worth flagging, because it cuts against the dominant narrative in the other direction. The framing all week has been banks versus crypto. Then CT publicly called for the Senate to pass the bill, so the banking sector is split, not united. Large banks exposed to custody and tokenization want the rails legislated. Smaller depository banks fear deposit flight. Anyone building a thesis on unified bank opposition is trading a strawman. Follow the money, start with the consumer, because that is where the real economic news was. Retail sales for July fell 0.6%. The street expected a small gain. That is the first monthly decline in 9 months and the steepest drop since May of 2025, led by a 2.2% fall at online retailers. And the University of Michigan's preliminary sentiment reading for August came in at 51, down from 55.2, ending 2 straight months of improvement. One-year inflation expectations actually ticked up to 4.3%. Now the honest caveat, a big part of the spending drop is boring. Americans got unusually generous tax refunds this spring, spent them, and that sugar high has worn off. Sales are still higher than a year ago, so this is a slowdown, not a cliff. But it changes the character of the disinflation everyone is celebrating. If prices are cooling because people stopped buying things, that is the kind of disinflation that arrives with an earnings problem attached, not the kind that comes from supply chains healing. The gap between what was expected and what arrived is the whole point. A forecast of plus 0.1%, an actual of minus 0.6. Economists cut third-quarter growth estimates on the print, and the sentiment detail matters as much as the headline, because the expectations component, which is how people feel about the future, is the half that actually predicts spending. That is the half that fell hardest. Now rates, and this is the part that deserves more attention than it got. The 10-year Treasury eased to about 4.68%. Calm. That is the market saying the Federal Reserve is on hold. The 30-year did the opposite. The Treasury sold $25 billion of 30-year bonds at 5.216%, the highest cost at that maturity since 2001, and up from 5.06% at July's sale. Demand was softer too. The bid-to-cover ratio, which simply asks how many dollars investors offered for every dollar of bonds on sale, came in at 2.39, below its 12-month average, and primary dealers had to absorb 11.5% of the issue. So the short end relaxed, and the long end printed a 25-year high on weaker demand. Those two are answering different questions. The short end is asking what the Federal Reserve does in September. The long end is asking whether investors want to fund this government for a generation. They stopped agreeing this week. Crypto, there was a genuinely large piece of good news, and the market did nothing with it. Tether completed its first full audit by a major accounting firm, receiving an unqualified opinion, with reserves exceeding liabilities by $6.814 billion, and the gold bars physically counted. That removes the single largest tail risk that has hung over the sector for years. At the same time, Europe is legislating that same product out of its market under the new rules, with one major platform auto-converting remaining balances at the end of the month. Separately, a Trump-linked venture received preliminary and conditional approval from the national bank regulator for a trust charter tied to issuing a stablecoin to institutional clients. Note the word conditional. Final authorization is withheld pending pre-opening requirements, and that is being widely reported as a completed bank charter, which it is not. And on supply, Binance's founder noted that just over 20.07 million Bitcoin now exist against a hard cap of 21 million. The arithmetic is right, but scarcity has been true for 15 years, and Bitcoin is still soft near 62,900. Scarcity is not a catalyst on any tradable horizon. Market sentiment. Our market and social sentiment monitoring showed a genuine split this week rather than a consensus. The loudest cluster of commentary was on artificial intelligence infrastructure, and it was notably more anxious than the price action, focused on financing structures rather than on demand. The second cluster was policy and crypto regulation, and there the commentary was materially more optimistic than the prediction markets, which is usually a warning sign rather than a confirmation. And the third theme, quieter but persistent, was traders describing this as a grinding, capitulation-free market. No single break, no obvious flush, just attrition. That is worth noting, because markets that never capitulate tend to stay expensive and fragile at the same time, and a volatility index at 14 is not pricing much of anything. The tell of the day, Berkshire Hathaway filed its quarterly holdings disclosure. Berkshire had been a net seller of equities for 13 consecutive quarters. This quarter that flipped, $23.5 billion bought against under $4 billion sold. The first net buying quarter in 14. And the largest single addition was Alphabet, increased by 83% to roughly 106 million shares, worth about $37.8 billion, making it Berkshire's third largest listed holding behind only Apple and American Express. $10 billion of that came through a private placement in June. Now hold that next to everything else in this brief. The most valuation-disciplined large allocator alive just made a very large commitment to artificial intelligence, and it chose the one expression of it that is funded entirely out of the company's own cash flow. No leasing vehicle, no residual value guarantee, no private credit tranche. That is the thesis of this entire brief, expressed as a position by somebody with real money on it. Sectors in play, 3 today. Semiconductors, where the story is now financing rather than demand. Broadcom fell 6% on a credit note, while advanced micro devices rose about 4% on a bullish price target from a research house, which tells you the sector is being sorted by balance sheet rather than by product. Energy and materials led the market on Friday, which fits the softer dollar and a market rotating away from crowded technology exposure. And consumer discretionary is the one to watch into next week, because retail sales, weak sentiment, and a 2.2% drop in online spending all point at the same set of earnings. Elsewhere, Reddit rose about 13% on inclusion in the S&P 500, which is an index flow event rather than a fundamental one, and Applied Materials sold off despite beating expectations, which is exactly the regime change one large strategist described this week. The market has stopped paying for growth alone and started asking for free cash flow with it. On the radar, next Wednesday brings a policy summit in Washington on digital assets, with both market regulators expected to attend. September the 15th is the procedural vote on the Clarity Act, and the prediction markets and the political commentary are currently far apart on it, which makes it a genuine test. Watch whether any other trading firm discloses a July mark, because Jane Street is unlikely to be the only one exposed to that unwind. And watch the next long bond auction, because that is the cleanest live read on whether the long end keeps decoupling. Now the scorecard. 3 new falsifiable calls today, and each comes with the way to prove us wrong. 1. The binding constraint on the artificial intelligence trade is financing structure, not valuation. We are wrong if the next 10% drawdown in the large artificial intelligence names arrives with no forced seller and no credit event attached. 2. More of this build-out keeps moving off balance sheets rather than back onto them. We are wrong if the major players start funding capacity primarily with straightforward corporate debt on their own books over the next 4 quarters. 3. Prediction markets, not political commentary, are the better guide to the Clarity Act. We are wrong if it passes both chambers this calendar year. The close, here is the question worth sitting with this weekend. For 2 years, the argument about artificial intelligence has been an argument about price. Too expensive, not too expensive. But the 2 things that actually broke this month were not prices. They were a levered fund and a leasing structure. So the question is whether you have been reading the right ledger at all. The demand can be completely real and the trade can still break, because those are 2 separate questions, and only one of them shows up on an income statement. That is today's brief. The full deep dive on the hidden leverage is linked below. This is research and education only. It is not financial advice. This has been the Asymmetric Daily Brief. I'm Earl, the asymmetric signal, one contrarian read a day. Subscribe.